here's something that will probably annoy you. The Federal Reserve tracks the finances of over 4,000 American households every 3 years in one of the most detailed wealth studies on the planet. And when they broke down what separates a household worth $160,000 from one worth $11 million, the answer wasn't a bigger paycheck. It wasn't a better job title. It wasn't even a higher salary. It was what they owned. By the time a household crosses into the top 1% of net worth in America, a threshold that now sits above $11.6 million, their money isn't mostly sitting in a savings account anymore. It's spread across 5 specific categories of assets. The same 5, almost every time. And here's the part that should genuinely bother you. Most people go their entire working lives never acquiring even one of these 5 things. They work, they save a little, they retire later than they wanted to, and they never understand why the wealth never seemed to catch up. In the next 20-something minutes, I'm going to walk you through all 5 assets, what they are, why each one behaves like a wealth machine instead of a paycheck, and the exact order in which wealthy people typically acquire them. I'm also going to show you the one asset that almost nobody talks about that shows up in nearly every wealthy household's portfolio before any of the sexy ones do. Stick around until the end because asset number 5 isn't something you buy. It's something you already have, and most people are sitting on it without realizing it's worth anything at all. Let's get into it. Before we go asset by asset, we need to clear up a confusion that keeps otherwise smart people financially stuck for decades: the difference between being well-paid and being wealthy. A surgeon earning $400,000 a year and a small business owner earning $110,000 a year can end up on completely opposite ends of the wealth spectrum, and it usually isn't because the surgeon is bad with money. It's because income is a flow. It comes in, and if it isn't converted into something else, it flows right back out, through taxes, lifestyle, and time. Wealth, on the other hand, is a stock. It's what's left standing still, working, after the flow has passed through. Research on U.S. household finances consistently finds the same pattern. Households don't build serious wealth by earning more, they build it by consistently converting earnings into assets, and specifically into assets that keep generating value whether or not the owner is actively working. That's the entire game. Every one of the 5 assets we're about to cover does exactly that. It produces value on a timeline that isn't tied to your personal labor. Keep that filter in your head for the rest of this video. Does this asset make money while I sleep, or does it only make money while I'm clocked in? That single question is the dividing line between almost everything that follows. Asset number 1 is the one almost every wealthy household has in common, and it's also usually the first one they acquire: real estate. Specifically, real estate that either shelters them from rent or actively produces income. Federal Reserve research on how portfolios shift across the wealth spectrum found something clear and consistent. For the broad middle of American households, real estate is the dominant asset in their entire net worth. Young households take on mortgage debt early, and that one decision, buying instead of renting, ends up anchoring their wealth for the rest of their lives. Real estate isn't glamorous. It's not the asset people brag about at dinner parties, but it is the asset that shows up earliest and most reliably across nearly every wealth bracket. Here's why real estate works so well as a foundational asset, mechanically. First, it's leveraged by default. You can control a $400,000 asset with $80,000 or even $20,000 down. No other asset class on this list lets an average person use borrowed money at relatively low interest rates to control something this large, this early in life. If that property appreciates just 5% in a year, you're not earning 5% on your money, you're earning closer to 25% on your actual cash invested, because the gain is calculated on the full asset value, not just your down payment. Second, it forces savings. A mortgage payment is really 2 things happening at once: interest, which is the cost of the loan, and principal, which is you paying yourself. Every single month, a chunk of that payment converts into equity, into ownership, whether you think about it or not. Renters pay 100% of their housing cost to someone else's asset. Owners redirect a meaningful slice of that same cost into their own balance sheet. Third, real estate can eventually flip from cost to income. The wealthy don't just own the house they live in, they own additional units, a duplex, a small apartment building, a short-term rental, a commercial property leased to a business. At that point, the asset stops being something they pay for and becomes something that pays them. Now, I want to be straight with you about the caveats, because too many videos on this topic oversell real estate as risk-free. It isn't. Property is illiquid. You can't sell a fraction of a house to cover an emergency. It comes with maintenance costs, property taxes, vacancy risk if you're renting it out, and it can lose value, particularly if you're over-leveraged in a downturn. The 2008 crisis is proof that real estate can go the other way violently when debt is stacked too high relative to income. The takeaway isn't buy any property anytime, it's this. Real estate is usually the first rung on the wealth ladder because it's the most accessible way for an average earner to control a large, appreciating, leverage-friendly asset early in life, and Fed data confirms that pattern holds true across generations of American households. If you don't own the roof over your head yet, or you don't own any income property, this is very likely asset number 1 on your list before you chase anything flashier. Asset number 2 is equity ownership. Owning small slices of businesses through stocks, index funds, or retirement accounts. This is where the data gets almost shocking. In the most recent Federal Reserve Household Survey, more than 90% of families identified as mini-millionaires, households that crossed the million-dollar net worth mark without extreme income, reported owning stock, either directly through a retirement account. 90%. That is not a coincidence, and it is not a small correlation. It is close to a universal trait among people who reach that milestone. Why does equity ownership carry so much weight? Because when you own a share of stock, you're not renting a return, you're owning a piece of an actual profit-generating machine, a company with employees, customers, and growth, compounding value on a timeline measured in years and decades, not paychecks. There's a mathematical phenomenon at the heart of this asset that almost nobody explains well, so let's slow down here. Compounding. If you invest and earn a 10% average annual return, your money doesn't grow by 10% each year in a straight line. It grows on an increasingly larger base every single year, because last year's gains are now generating their own gains. A dollar invested at age 25 does dramatically more work than the same dollar invested at age 45, not because the 25-year-old is smarter, but purely because of time. This is why financial researchers so consistently point to time in the market, not timing the market, as the dominant driver of long-term stock returns. There's also a second reason equity is such a core wealth asset: liquidity paired with growth. Unlike real estate, you can sell a stock in seconds. Unlike a savings account, that stock has historically outpaced inflation by a wide margin over multi-decade periods. It gives you the growth profile of an illiquid asset with the flexibility of a liquid one, which is a rare combination. Now, here's where the mini-millionaire data gets really interesting. Those Fed-surveyed households weren't picking hot stocks or timing market crashes. Their profile skewed toward consistent earners, often in that $150,000 to $250,000 household income range, who kept contributing steadily to retirement accounts and taxable brokerage accounts over long stretches of time, riding out downturns instead of panic selling. Their median wealth jumped sharply between 2019 and 2022, tracking closely with how the broader stock market performed over that same window. That's the entire strategy: consistent contribution, long time horizon, and staying invested through volatility instead of reacting to it emotionally. This is also the asset where the wealth gap becomes most visible by generation. Research on portfolio composition across the wealth distribution shows that as households age and accumulate more wealth, stocks and business equity make up a larger and larger share of their holdings, while real estate's share, though still significant, becomes relatively less dominant. In other words, real estate gets you started, but equity is what takes you from comfortable to wealthy. If you already own your home and you're not contributing meaningfully to a retirement account or a brokerage account, this is very likely your next move. Not because it's exciting — buying an index fund is one of the most boring financial decisions a person can make — but because boring in wealth building is usually a feature, not a flaw. Asset number 3 is where the wealth curve stops looking like a line and starts looking like a hockey stick. Private business equity. Actually owning a company, not just shares of a public one. This is the asset that consistently shows up as the defining feature of the ultra-wealthy specifically, as opposed to the merely comfortable. Research comparing household portfolios across the wealth distribution finds a strikingly consistent pattern. The richest households are dramatically more invested in business equity than every other bracket beneath them. It isn't that wealthy people happen to also own businesses. Owning a business at meaningful scale is one of the primary mechanisms that makes them wealthy in the first place. Economists studying the drivers of wealth concentration have specifically examined entrepreneurship's role in this, and the pattern is not subtle. A large share of the wealth gap between the top 1% and everyone else can be traced to business ownership, not salary, not stock picking, not inheritance alone. Why is owning a business so much more powerful than owning stock in someone else's business? 3 reasons. First, control over value creation. When you own stock, you're a passive rider on the decisions of a management team you'll never meet. When you own a business, every decision you make, a new product, a better process, a smarter hire, flows directly into the value of the thing you own. You're not hoping the machine gets better, you're building the machine. Second, multiple income streams from one asset. A business can pay you a salary, distribute profits, and also grow in resale value simultaneously. 3 separate financial benefits stacked on a single asset. Compare that to a stock, which really only offers price appreciation and sometimes a dividend. Third, the eventual exit. This is the mechanism that turns years of modest owner income into a single life-changing wealth event. A business that generates, say, $200,000 a year in profit might sell for 2 to 4 times that annual profit or more depending on the industry and how systemized the business is, meaning how well it runs without the owner physically present. That's not a bonus. For a huge share of newly wealthy individuals, that exit is the single largest wealth event of their entire life, dwarfing decades of salary. I want to be honest about the risk profile here too, because entrepreneurship gets romanticized constantly online. The failure rate for new businesses is high. Cash flow is unpredictable. There's no guaranteed paycheck, no employer-sponsored retirement match, no safety net. This is precisely why business equity tends to be asset number 3, not number 1. Most people who eventually build or buy a business first spend years stabilizing their finances through real estate and equity ownership, building the runway and risk tolerance that entrepreneurship requires. But here's the important nuance. Owning a business doesn't have to mean quitting your job and starting the next tech unicorn. It can mean buying a small, boring, profitable local business from a retiring owner. It can mean owning a meaningful equity stake in the company you already work for. It can mean a side business that starts small and eventually replaces your salary entirely. The size doesn't matter nearly as much as the ownership structure. Are you an employee trading hours for dollars, or an owner whose asset can generate value independent of your hours? That question is the real line between asset number 2 and asset number 3, and it's why the data shows business equity concentrating so heavily among the truly wealthy. Asset number 4 is the quiet one. The one that rarely gets its own headline but shows up constantly once you start looking for it. Intellectual property. Patents, trademarks, copyrights, licensed software, published books, courses, music catalogs, brand names. What intellectual intellectual property distinct from the first 3 assets is the cost structure. A rental property costs money to maintain, repairs, taxes, insurance. A business has ongoing overhead, payroll, supplies, rent. But intellectual property, once created, often has close to 0 marginal cost to reproduce and sell again. A software license can be sold to the millionth customer for nearly the same cost as the first. A book, once written, can be reprinted or re-downloaded infinitely. A patent can license the same invention to multiple manufacturers simultaneously, each paying a royalty without the inventor lifting another finger. This is the closest thing in the real economy to money that manufactures itself. Think about how many wealthy individuals across different industries hold at least one meaningful piece of intellectual property: proprietary software, a branded product line, a patented process, a media catalog, a trademarked name that customers recognize and trust. Even businesses we categorized under asset number 3 usually derive a huge portion of their sale value specifically from intellectual property, a recognizable brand, proprietary systems, or protected technology rather than from physical assets like equipment or inventory. When a business sells for several times its annual profit, buyers are very often paying primarily for the intangible asset, the reputation, the process, the code, the customer trust, not the desks and the delivery vans. This is also the asset that most rewards a very specific kind of effort, front-loaded, one-time creative or technical work that pays out repeatedly afterward. Writing a book takes months of work up front and then can sell for years. Building a piece of software takes intense initial effort and then can be licensed to thousands of customers with almost no additional labor per sale. This is fundamentally different from a service business where your income is capped by how many hours you personally have to sell. The barrier to entry here has also collapsed dramatically over the last 2 decades. Creating and protecting intellectual property used to require large legal budgets and publishing gatekeepers. Today, an individual can copyright a piece of writing, trademark a brand, or build and distribute software with a laptop and an internet connection. That doesn't mean it's easy. Creating something people actually want to pay for repeatedly is still hard, arguably harder than any of the other assets on this list, because it requires genuine originality or genuine utility, not just capital. But the access to build this asset class has never been more available to an average person than it is right now. If you have a skill, a piece of writing, a process, or an idea that solves a real problem, this is the asset category most within reach without large amounts of starting capital, which makes it a natural entry point for people who don't yet have the money to buy real estate or fund a business but do have expertise or creativity to package. Asset number 5 isn't something you can hold deed to, and it never shows up on a balance sheet. But every single asset we've talked about so far was purchased using it. Human capital. Your skills, your knowledge, your relationships, your reputation, and your ability to solve problems that other people will pay for. I saved this one for last because it's the most overlooked and because the data on it is almost impossible to ignore once you see it. Analysis of the same Federal Reserve Household Survey found that the percentage of people reaching millionaire status by ages 55 to 64 more than doubled among college graduates compared to the general population in that age bracket. That's not a small edge. That's the difference between roughly 1 in 5 households and nearly 1 in 2. Now, before anyone assumes this section is a simple get a degree pitch, it isn't. And the data doesn't actually say that either. A college degree is one delivery mechanism for human capital, but it isn't the only one and it isn't guaranteed to work on its own. What the degree tends to correlate with is something deeper, a compounding skill set, a professional network, and, critically, a set of behavioral habits. This is actually where a lot of financial research converges on a point that surprises people. The classic study of self-made millionaires, The Millionaire Next Door, found that raw intelligence or an elite education mattered far less than most people assumed. What separated ordinary earners from wealth builders was consistent effort, disciplined focus, and financial habits repeated over decades. Fed survey data backs this up from a different angle. The households that built wealth fastest weren't necessarily the highest earners. They were disciplined savers and investors who consistently redirected income into assets over long stretches of time, kept their spending in check relative to their income, and stayed invested through market swings instead of reacting emotionally. That combination, a marketable skill, plus the discipline to consistently convert income into assets, is human capital in its most practical form. It's what lets a plumber save enough to buy his first rental property. It's what lets a software engineer negotiate equity instead of just salary. It's what lets a marketer eventually leave to start her own agency. Every other asset on this list was purchased with either money or time, and money and time both trace back to the value of your skills and your habits. Here's the practical implication. If you're starting from zero, No real estate, no investments, no business, no intellectual property. The highest leverage move you can make isn't to chase one of those four assets directly. It's to invest in the skill or credential that increases your earning power and to build the saving and investing habit that lets you convert that higher income into the other four assets before lifestyle inflation eats it. Every wealthy household, when you trace their story back far enough, started exactly here, long before the first rental property, the first stock purchase, or the first business. Let's bring it all together. Asset 1. Real estate. The accessible, leveraged foundation that anchors most households' wealth early in life. Asset 2. Equity ownership. Stocks and retirement accounts, the asset present in roughly 9 out of 10 households that cross the millionaire threshold. Asset 3. Business equity. The asset most concentrated among the ultra-wealthy specifically, because it converts control and effort directly into compounding value and, eventually, a life-changing exit. Asset 4. Intellectual property. The quiet, low marginal cost asset that turns one-time creative or technical work into repeatable income. And Asset 5. Human capital. The invisible asset that funds every single one of the other four, and the one place almost anyone, regardless of starting point, can begin building today. None of these assets is a shortcut, and none of them showed up overnight in any household the Fed surveyed. They compounded, quietly, over years, often decades, through consistent decisions rather than a single lucky break. If there's one thing worth taking away from this video, it's this. Wealth isn't a mystery, and it isn't reserved for people who got a head start. It's a fairly well-documented pattern repeated across millions of households of converting income into these 5 categories of assets in roughly this order, and then giving them time to compound. The only real question left is which one of these 5 you don't own yet, and what you're going to do about that this year, not someday. If this broke down something you'd never seen laid out clearly before, let me know in the comments which asset you're focused on building next. And if you want the follow-up video where we go deep on exactly how to acquire asset number 1, starting with your very first dollar, make sure you're subscribed because that's coming next.